So good morning, everyone from both the audience on site and also online. It's my pleasure to introduce Peter Hördahl, Principal Economist at the BIS, who will be here today. His seminar on predicting financial market stress with machine learning. His research focus is on asset pricing and term structure of interest rate, particularly bond yields and term premia. Prior to joining the BIS, Peter also worked at both the ECB and the Swedish Central Bank. So he has professional experience across the three major central banks. So we are delighted to have him with us today. So for 1 hour seminar, we'll have the presentation about 40 minutes. If anyone has question, like clarification question along the way, feel free to interrupt. Is that okay? Yeah, and then at the end, we will have some more time, 20 minutes for Q&A. Okay.
Thank you very much for that introduction. And thank you also very much for hosting me and for letting me present this research here. I'm excited to be here first time not in Thailand, but first time at the Bank of Thailand. So I look forward to your comments on the paper and discussions afterwards. So let me say this, as you heard, my research is focused on asset pricing, term structure stuff. So machine learning is something new for me, but I find it interesting. I found the results interesting, and I think there's something there. I was skeptical about this black box, but I hope I can convince you that there is something useful there. So this is joint work with Iñaki Aldasoro, Andreas Schrimpf, and Sonia Zhu, also all at the BIS. And let's get started. See, yep, that works. So just by way of motivation, it's clear that the provision of liquidity in financial markets has changed in the last few years, last decades possibly. There's been a shift from banks to non-bank financial institutions, in part because of regulation, but also in part because of the growing footprint of NBFIs in markets. And we've also seen the advent of high-speed trading and automated platforms and so on and so forth. And to what extent that's linked to market stress is unclear, but for sure we've seen more frequent episodes of market stress and perhaps also more widespread market stress. By market stress, we mean market dysfunction or situations where the markets are actually functioning, but conditions are characterized by low liquidity. So we would see price formation being impaired, buyers and sellers having a hard time meeting in the marketplace. So price discovery would be difficult, and we could even see a breakdown of no arbitrage relationships in the market. And so there would be pressure on authorities to intervene, and we've seen a number of cases where central banks have had to step in as market makers of last resort, like the Fed did during the COVID onset crisis, like the Bank of England had to do during the Liz Truss mini budget fiasco in the UK in 2022, and so on and so forth. So I think for central banks and other authorities, it's of interest to know whether financial market stress conditions are actually predictable, and in particular if we can predict them out of sample. So predicting them in sample is perhaps interesting to understand what's happening, but it would really be useful if we could do it out of sample. And here, given the kind of complexities of financial markets, the non-linearities that may be involved, we ask the question whether machine learning models can help us gain predictability of stress conditions. And if so, what type of indicators are important for predictability? As mentioned, if there are any clarifying questions, please feel free to interrupt. Okay, so what we do First of all is that we measure financial market conditions, and to do that we expand on previous research we had before with my co-authors, where we introduced so-called market conditions indicators, MCIs. And we do this for three key market segments that are centered around the US dollar. So that's the US Treasury market, the US money market, and the foreign exchange market. And each of these market conditions indicators for each of these segments is estimated simply using a principal component analysis, which we apply to a broad range of variables that capture different things that could be related to market stress, such as market illiquidity, market volatility, and price dislocation measures, so measures of breakdowns of arbitrage relationships. So we are able to do this essentially in real time. We have daily frequency, and we aim to be able to update this on the BIS data dashboard. So the data is there publicly available, but it's not updated as often as we would wish. So we need to improve on that front. But if you're interested, you can go to our website and have a look. Yes. So our paper in a nutshell, what I'm going to be talking about today is what we do is we build on these MCIs in that we construct out of sample market conditions indices with expanding window PCAs. So because we're interested in out of sample forecasting, we don't want to have the kind of a look ahead bias when we construct our indices. So we only consider past information and do a rolling estimation of that. So that's one aspect. And then we want to be able to do our best in predicting the future distribution or the future kind of moments, future quantiles of the MCIs using machine learning methods. And here we focus on tree-based methods, so the random forest, and we show that in most cases it outperforms classic regression models or classic time series models. So it actually does pretty well, and it does this both in sample and out of sample. We test in sample as well. And then because this is a little bit of a black box, we try and uncover what are the leading indicators that help us predict market stress or stress conditions in markets. And it turns out that market implied macro and monetary policy indicators are quite important across all market segments. So this has to do with the interest rate environment, so the stance of monetary policy and uncertainty related to that and expectations about monetary policy. And this shows, because this is all centered around the dollar, this really shows the importance of Fed monetary policy and expectations of that and uncertainty about that in markets, and also for stress conditions. And in addition to that, we also find for individual markets that other types of variables, such as those that capture investor sentiment or the global financial cycle, or those related to liquidity conditions may matter too, and I'll get into the details later on in the results. Okay, so as I mentioned, we construct the MCIs with principal component analysis, and we use the same type of variables as we did before, although we do this now out of sample. For the treasury market, we have volatility information, so the move index. We have market liquidity information, so we have bid-ask spreads. We also have data on the time to quote from BrokerTech. So this is the time it takes for a broker to get back with a quote once they are asked for a quote on a treasury bond. And the longer time it gets, the less liquid is the market in some sense. We have the Bloomberg Treasury Liquidity Index. So that's the kind of the deviation of bond yields or bond prices from a smooth fitted curve. And we have price dislocation measures, so on the run liquidity premium, the OIS Treasury spread, and the Treasury futures basis. For money markets, we rely mostly on various spreads, so commercial paper OIS spread, the repo OIS, TED spread, and so on and so forth. And for the FX market, we have, again, implied volatility indices and also market liquidity indicators such as the spread, bid-ask spreads, and price dislocation measures. For example, the cross-currency basis or the triangular violation of the law of one price, where you look at three currency pairs and you check whether there are violations of the law of one price. So once we have constructed our market conditions indices, this is what we get. So this is for the treasury market, the money market, and the foreign exchange market. This is time from 2003 to 2025 at some point, or 24, I can't remember, 2024, when we finished the sample. The blue line is the in-sample full MCI. The orange one is the rolling estimation one, and they show the same picture with some deviations at the beginning. And we see that we capture pretty well the big events. So we have spikes for all three markets around the collapse of Lehman Brothers, obviously, at the onset of COVID again. But we also see that we have spikes in the market conditions indices that are more market specific. For example, the money market spiked early on in 2007 at the very beginning of the global financial crisis, whereas we saw almost nothing in the foreign exchange market and very little in the treasury market. So we think there is interesting information coming out of these. And I should say these are all standardized. So the scale here is, they're all like mean zero, and the one would be one standard deviation above the mean. So these are quite big kind of increases in market stress, 10 standard deviations, for example. We also capture other kind of market-specific phenomena, like, for example, this increase in the treasury market MCI is related to the taper tantrum in 2013, when the Fed started talking about tapering QE and the market got all spooked. But this is again specific to the treasury market. We saw almost nothing in the money market, nothing in the FX market. For the FX market, we capture the depegging of the Swiss franc. That's this spike here. And then later on, the kind of increase leading up to the Brexit vote in the UK. So we think these make sense intuitively, at least to us. So now the interesting question, I think, for us is, are these market conditions predictable? And this is obviously, as I mentioned before, policy relevant, because central banks want to be able to predict market stress, so they perhaps can do something about it before it materializes. And so what we are interested in is a situation where the MCI at some time t is greater than some threshold, whatever that may be. And the threshold is going to be in the right tail of the distribution, so when the MCI is high. So to be able to predict stress episodes, we want to be able to predict the right tails of the distribution of these indices, and that can be obviously time varying. And so what we do in practice in the paper is we forecast on the 90th or the 95th percentiles of the MCIs across these market segments. And we want to be able to benchmark our results against something that makes sense intuitively. So we benchmark it against classic time series models. And the first one, the kind of immediate one people think about, is a classic autoregressive model. And so think of it as fitting a quantile tau, for example, the 90th quantile of an MCI, say for the FX market at time t, as a constant plus an estimated lag of the MCI of FX, lagged depending on the forecast horizon h months back. Now we want to give the model a chance to do better, so we also include lagged MCIs of the other two market segments, so we can capture kind of cross-market interactions if there are any. So that's what we call the AR model. It's not strictly an AR model, but we call it that for short. So that's one of the benchmarks. And we do this with rolling estimation with 84 observations, so 7 years of data. And our sample period runs from January 2003 to May 2024. We have a second potential benchmark model that we compare our results with. And that's a linear model that, in addition to the lagged MCI variables that we had in the previous benchmark, we add a broad list of explanatory variables X, which we call this the full model. And here we consider 44 candidate explanatory variables that we group under 6 categories. So we want to throw in as much as possible that we think could help us forecast the market conditions. So these types of variables that we throw in are related to things like funding liquidity. So, for example, we have Fed purchases of US government bonds, so QE, QT. We have the US Treasury's general account, so that's their account with the Fed that affects liquidity conditions. We have the number of fails in the US Treasury settlements in repo markets. We have, for example, the primary deal on net coupon treasury holdings, and Du et al. Show that this is related to the risk-bearing capacity of dealers and hence related to funding liquidity. And we have the volume of total commercial paper issuance. The more commercial paper is issued, the more it tends to crowd out money that could be invested in government bonds, for example. So that could lead to tighter conditions in bond markets, in government bond markets, I mean. We have fund flow variables. So we have EPFR, fund flows between developed and emerging bond and equity markets, various other indices from them. And we have intra-family flows that capture things like risk appetite and sentiment. And this is based on research by Ben Raphael and co-authors. So, for example, shifts within a family of funds from investment grade to high yield bonds would signal increase in risk appetite, or a shift from bonds to equity funds would signal a better sentiment, investment sentiment among investors. We have risk preference variables. So we have the excess bond premium from Gilchrist and Zakrzajsek. We have the broad dollar index, DXY, and we have the global financial cycle index. We have the margin of 10-year Treasury futures, and then we have macroeconomic conditions, so economic surprise indices, the 3-month US Treasury bill rate, so that's related to the stance on monetary policy. We have the difference between the 10-year and 2-year Treasury yield, so the slope of the yield curve, which is a reliable, or has been a reliable recession indicator. And we have the same type of yield difference, but at the short end, 2-year, 3-month yield slope, which is related to expectations about US monetary policy. And then finally, we have market volatility and monetary policy uncertainty variables. We have the VIX, the MOVE, and the skew indices. We have FX implied volatilities, and we have interest rate swaption implied volatilities. And on top of that, we have the lagged values of market conditions indicators themselves. So we throw all of this into the full model that I discussed before. So those are the 2 benchmark models that we compare our results with. So now turning to the machine learning. So this is kind of, we want to see whether using machine learning we are able to beat these 2 benchmarks. So there are different kinds of machine learning approaches. There's neural networks, there's tree-based, and so on and so forth. So in order to kind of pick one, we looked at the literature, and we saw that people like Grinstein And co-authors have shown that tree-based models tend to outperform deep learning models, neural networks and so on, for regression data or tabular data, as they call it. So this is like time series data that we have instead of, say, categorical data. But for our type of data, the tree-based models tend to do well, and they also tend to be more easy to interpret than deep learning models, or slightly easier. So this is also an advantage if you're in a policy setting, because you want to be able to understand a little bit what's going on inside the black box. So we focus on tree-based machine learning models, namely the random forest. And we do a robustness check with the extreme gradient boosting with a different type of forest-based or tree-based model. And in a recent extension, we also did another robustness check with neural networks, which I will mention later on. So I'm guessing most of you are familiar with the random forest model, but I'll just go through very quickly the intuition behind it. So a random forest is made up of a number of different decision trees. And a decision tree is just a collection of choices that are sequential and the results. So you start with a root node, say you're interested in predicting something like a loan approval. You're working in a bank and you have information on a customer and you want to see whether you should approve a loan to that customer or not. So you start with perhaps that the customer's income. If it's higher than something, then you go to the next node. If it's lower than something, you go to one node. And here you have other things like job history, for example. I don't know if they own a house, that kind of, if they have collateral, and so on and so forth. You can have many of these types of nodes, and in the end you get to a leaf node, and a leaf node says yes, do give a loan to this customer, or no, yes or no, or perhaps yes, no, yes, yes, and then you have all of this from one decision tree, but you have many trees, and you tend to you then kind of aggregate this across all the trees. You take the average, or you take the consensus among the trees, and that gives you the answer based on the data that you put in. Now, for regression trees, it's similar, but you have a continuous data. For example, our MCI data. And so here you get different values of MCIs leading down to the leaf nodes, and you average across all of these trees to get a result for the entire random forest. And that's what you see here. You have a number of trees, and you aggregate them into a final result. Now, the random forest is called random because there's two types of randomness. You subsample the data when you feed it into the tree. If you feed in the same data to each tree in the same way, then you get exactly the same result. So it wouldn't make sense. So what you do is you subsample with replacement to get a random type of data that reflects the data you have. And you also select a random subset of the features. Now, features is kind of machine learning, a machine learning term for the variables, the input variables that go into explaining or predicting what you're interested in. So you have, say, 50 features that could potentially help predict the MCI in our case, but you only select a random subset of them, say a third of them. And you build your tree based on that random subset and based on the random data you have been training the tree on. And then again, you do this many times, and you aggregate across the decision trees to get your final result. So that's how that works. Oops. Now, yes. We need to be able to evaluate the prediction errors, and we do this in the usual way we do for quantile regression. So we use the pinball loss. So the pinball loss for a quantile tau is simply tau, so the quantile times the realization of the MCI in our case minus the predicted value of the MCI if the realization is greater than the prediction, and otherwise is 1 minus tau times that difference. So why do it this way? Well, this gives us an asymmetric loss function if tau is not exactly 0.5. So for example, for high taus, 0.9, which is the taus we are interested in the right tail of the distribution, under predictions, so when this is low, would be penalized more than over predictions, because then this kicks in and you get it kind of a loss that is weighted with a high value 0.9, and that's so you want to be able to kind of get to the right tail of the distribution by penalizing any forecast that is too low, essentially. So that's the kind of the intuition behind that. And so the total quantile loss averages the pinball losses across all of the observations for that quantile. So we can do this both for our benchmark models and for the machine learning model. Now, let's start with the benchmark models. So first, in sample quantile loss. So these shows us for the treasury market, for the 50th percentile, the 75th percentile, and 90th and 95th percentile, shows us the quantile loss for the simple AR model and for the full model that includes all of those 44 extra explanatory variables. Now, as you can see, in all cases, the AR does much worse. It has much higher quantile loss than the full model. So the full model does brilliantly in sample, and this is true for the money market. The red line is always below the blue one, and for the FX market, the same. Now, we know that these models tend to, especially the one with lots of variables, tend to overfit in sample. So we do the same out of sample. Again, treasury market, 50th, 75th, 90th, 95th percentile. And now the result reverses. So the full model now has greater quantile loss, so that's the red line, than the simple AR model. So out of sample, the simple AR model does pretty well. And the same goes for the money market and for the FX market. And this is just all to say that for our out of sample benchmark, we choose the AR model, which does much better than the full model. But we gave the full model a kind of a run, a chance to compete. So now we can compare our random forest predictions of the quantiles with the AR model that we chose as our benchmark. And I'm going to focus here on the 90th percentile because we're kind of interested in the tail. And we have our three markets, treasury, money market, and FX. And what these lines show is the difference between, let me see, the random forest quantile loss and the AR model's quantile loss. So negative values means that the random forest model does better than the AR model, and positive values is the opposite. Now, starting with the treasury market, we see that actually here, in this market, we tend to not do much better, or we don't do better than the AR model. So we're kind of the same up until 9 months ahead. This is all prediction horizon in months. So up until around here, we're kind of not statistically significantly different from zero in terms of the difference. And here we're kind of slightly worse than the AR model. But for the other two markets, the money market and the FX market, we, apart from the kind of one step ahead, one or two, and perhaps the very longest forecast horizon, we tend to do significantly better than the AR model. And the same goes for, if we go even further out in the tail, the 95th percentile, the picture is very similar. So at least for these two markets, we beat the AR model. For this market, is kind of similar. In some cases, the AR model does slightly better. So we found that encouraging for the machine learning tree-based model. So based on this now, how can we interpret this? What predictors are most important? And as I said before, these kind of approaches are a little bit black box. So in order to untangle this a little bit, we focus on so-called Shapley values. Shapley analysis is usually used in game theory, but we apply it here to this. And forget about this equation. Intuitively, it's essentially you have all of the explanatory variables, all of the features. You take one out, and then you consider all possible combinations of the other features, and you see how much, on average, across all of those combinations, would the inclusion of this one variable change your forecast of the MCI in our case. And the bigger the impact of that variable, the more important it is in some sense. Okay? So that's all that this is. And it takes a long time to run on a computer, but it works. Hopefully it works. Okay. And so what you get is a lot of numbers. And so how can you visualize the results? So one way of doing it is this so-called B-swarm summary plot of the Shapley values. And it's called a B-swarm summary for obvious reasons, as you can see. And it consists of all of our explanatory variables. These are the 44 I mentioned before. You can't read them. That doesn't matter for now. Just it's all the variables. And they are sorted by the ones that are most important to the least important. In what sense? In the sense that they move the Shap value, the Shapley value. And that means that is their impact on the forecast of the MCIs. And the impact is in terms of mean absolute value of how much it moves the forecasts. Okay. So 0 is here. This is positive. This is negative. So if you see a lot of values here, that means that this variable tends to increase the MCI, the forecast of the MCI. So it tends to point towards more stressed conditions. Now we also see colors, red and blue. So red means high values, blue means low values. So for this variable, the red values tend to push up the forecast. And so the red values are high values of this thing. I can read it here. It's the 3-month, 2-year swaption implied volatility. It doesn't matter, but this is just to give you some kind of intuition of how these things. I'll go into the kind of more detailed results in a second. So this is how we kind of present and try to get some interpretability of the what's in the black box. So let's then look into the 3 markets. I think I still have time. So let's start with the Treasury MCI, and we're focused on the 90th percentile, and we focus on 6 months ahead because it's kind of in the middle of the entire range of forecast horizons that we consider. And so these are the top 5 variables that affect the forecast of the Treasury MCI 90th percentile. Okay, so what do we see? We see that there is some kind of theme among these 5 most important variables in that it's interest rate uncertainty and slope are important predictors, but also sentiment. So interest rate volatility, that's what I mentioned before. Swap 3M2Y is the 3-month, 2-year swaption implied volatility. And as I mentioned before, when that implied volatility is high, so red values, that tends to push up the forecast of the 90th percentile MCI. So it points to more stress conditions in the Treasury market. The yield slope, we also have the move, by the way, which is another implied volatility measure. It has a similar effect. The yield slope is also important. So we have the 10-year, 2-year yield slope. As I mentioned before, that's an important predictor of recessions. And so when this is very low, the blue points, we tend again to have an increase in the 90th percentile MCI for the treasury market. When that's low, that's when the yield curve is inverted. So that's when markets may be expecting a recession. So they are on edge, perhaps, and this tends to push up this MCI for the treasury market. But it's not only the blue ones in this case that push them up. Sometimes the red ones appear here. So when the yield curve is very steep, that can on some occasions also push up this 90th percentile MCI. So that's when for example, when you have a very high term premium, or you have very expectations for a very aggressive tightening of monetary policy, something like that. That can also spook the treasury market. But it's not always. So sometimes the red ones are centered around zero. So this shows, I think, the ability of the machine learning approach to kind of non-linearly get results that differ. So it's not always the case that a high value leads to something and a low value leads to something else. It depends on the interaction with the other variables. Let me go to the money market. Similar type of explanations. So here we have the global financial cycle index is kind of the top feature here. We have the interest rate environment is also important, just as for the treasury market, and liquidity conditions are also important. So for the GFC, global financial cycle, when that is red, so when we have a high GFC values, that means the financial markets are booming. So obviously that's a good thing for markets, and especially apparently for the money market, it's more calm. It tends to push down the 90th percentile of the money market MCI. The interest rate slope and level, we have the slope, similar effect as we saw for the treasury market, very low values, so inverted yield curve tends to push up the MCI's 90th percentile. The level, when the 3-month rate is very low, that tends to instead push down the 90th percentile MCI. That's when monetary policy rates are very low, so liquidity is abundant, right? So that makes sense. And then we have Fed Treasury purchases. That's this one here. High purchases means, again, lots of liquidity is being pushed into the market, and that lowers the MCI, the 90th percentile. And blue ones means that low values, or QT possibly even, tends to do the opposite, and that raises this percentile. Okay, and let me spend 1 minute on the FX market. Here we see that it's the short-term interest rate slope that matters. So that's related to monetary policy expectations of the Fed. When this is red, that means it's very high, so it's very sharp upward slope. So markets expect the Fed to be aggressively tightening in the short run, and that tends to lead to nervousness in the FX market, apparently. Implied volatilities also matter. We have the euro implied volatility seems particularly important, euro dollar. High implied volatility values pushes up the MCI, low pushes them down, all intuitive. Same for interest rate volatility. Yeah, this is swaption. It's kind of similar, low and high, although there are some low ones that also seem to be pushing up the MCI. And then we have a cross-market influence that seems important here. So this is the lagged MCI for the treasury market. When that was high before, that spills over to the FX market apparently, and vice versa when it was low. So this is just by way of long-windedly showing you that you can get some kind of interpretability for these results, even though the machine learning approach is a little bit of a black box. Now, the last thing I want to talk about in the last 5-10 minutes is that we use these results to fit the full distribution of the forecasted MCIs based on our random forest method. And we follow what Adrian and Al did in their AAR paper for a completely different type of set of questions. And we use the estimated quantiles between 0.05 up to 0.95 at each forecast date to fit a skewed t distribution to capture the full forecast for the MCI at for each forecast horizon. So why a skewed t distribution? Well, it's very flexible. The t distribution in itself allows for fatter tails than a normal distribution, and because it's skewed, you can also have skewness, which is a good thing. So you can capture a wide range of possible shapes of distributions. So this allows us to study how these distributions potentially evolve over time and their sensitivity to different predictions. So the first question is whether they actually evolve over time, and they do. So here is, for example, the distributions for the Treasury MCI 6 months ahead over time from 2010 or so up until the end of the sample. And as you can see, they vary a lot in terms of variance, in terms of fatness of the tails, but also in terms of the skewness. So sometimes it's positively skewed, sometimes negatively skewed. So there's a lot of variation going on. Now, given this, you may ask whether these kind of distributions make sense. Are we capturing them properly? And in order to evaluate the way we have estimated these distributions, we look at the probability integral transforms that evaluate the predictive cumulative distribution at the realized value. So that's just a long way of saying that we look at the percentage of observations that are below a given model implied quantile. And the model implied quantile comes from the random forest approach. Now, if the model is right, then this cumulative distribution of these PITs will lie on a 45-degree line. So each observation, so the observations would correspond to the quantiles that come from the model. So we can look at that for the different markets, for the Treasury market, the money market, the FX market, and we can look at it across different forecast horizons. This is 1 month, 3 months, 6 months, 12 months. And so, as I said, ideally we would want to be on this theoretical solid blue line. That's when the empirical kind of quantiles, if you wish, correspond to the implied quantiles, and the red line shows what the outcome is when we use our estimated models. And in all cases, we are pretty close to the 45-degree line, and in all cases, we are within the 95% confidence bands of the theoretical optimal diagonal that we would see. So this, we think, shows that our approach is pretty good at capturing the different distributions of the MCIs, both across market segments and across forecast horizons. So what can we do with this? We can, let me just focus on one market, save some time. We can look at some interesting points in time and see what affects the distribution at that point in time. So this is what we do. This is for the FX MCI, 6 months ahead. We look at the densities of that MCI. And we pick one point in time. This is December 2014. And why is that important? Why is that interesting? It's interesting because just after that, in early 2015, the Swiss National Bank depegged its currency, the Swiss franc, from the euro, and there was a lot of volatility in FX markets, and it spilled over across different currency pairs, and there was stress in the market. Now, I think no one could have foreseen that, maybe not even the Swiss National Bank, that this would happen. So what we are trying to see is whether conditions in the market were such that the market was particularly vulnerable before this happened to market stress. So how do we do that? So first of all, we can look at what the benchmark random forest results said about that particular point in time. It said that the MCI, the density of the MCI for the FX market was centered around 1 standard deviation above 0. So it was pointing to more stress conditions than normal. It was also had a relatively large variance, at least compared to the orange line, and I'll get to the orange line in a second. So there was a lot of uncertainty, and there was a considerable mass also quite far out in the tail, right? In the right tail, which we are interested in. So we want to compare this, this kind of model implied benchmark with what a counterfactual thought experiment. And that experiment restricts the most important feature, the most important explanatory variable. And in this case, it's the 2-year, 3-month yield slope, which I mentioned before. That was the most important one for the foreign exchange market. So we fixed that value at its mean. But since these explanatory variables, the features are quite correlated among themselves, if we only fix that one, the random forest model is able to, once we rerun it, to make up for it with some of the other variables and get somewhere pretty close to where we got with the blue line, even though we have left one variable out. So we also restrict other variables that are highly correlated with this one that we're interested in, and arbitrarily we have a cutoff of a correlation of 0.6. So if the correlation is 0.6 or higher, we restrict those other variables, and that means that we restrict the interest rate level and the other yield slope, which, yeah, it's kind of intuitive that these are highly correlated with the short-term yield slope. So those are all restricted to not to 0, but to their in-sample mean. And then we run the random forests method. We do it for all the various quantiles, and we fit the distribution. And what we get is this orange distribution here. So that, to us, tells us that the importance of this top feature and its siblings is that if we had not included that information, we would have had a much more benign picture just before the Swiss franc depeg. So we would have had a distribution that was centered much closer to 0 and was less, had less variance. So there was less uncertainty and much less probability mass in the kind of the right tail of the distribution. So we, as policymakers, I think we would have been sensed into a false sense of, lulled into a false sense of calm. So that's just one way that we think that one can look at what's behind the kind of what gives rise to these distributions. Okay, that's it. So let me conclude. What we find is that we apply this tree-based machine learning machinery to check whether we can beat classic time series model in predicting the distribution of financial market conditions. And we do this out of sample, and in most cases, we tend to outperform. And we are able to use this, again, this machinery to pretty accurately fit the full forecast distribution across all our 3 MCIs and across all our forecast horizons. And then we quantify the importance of individual predictors using Shapley values, and we find that in general, market-applied macro and monetary policy indicators are important across all 3 MCIs. showing the importance of the Fed, and also that investor sentiment, the global financial cycle, and liquidity conditions can matter for individual market segments. Thank you. Let me stop there. Any questions? Happy to take them.
So we also have like 56 participants online. So if anyone online also have questions, feel free to like raise your hand or send in question in the chat.
I've noticed that you applied VIX index to predict financial rates in the financial market, and also with spread of government bond to represent liquidity in the Treasury MCI. So I was wondering if you have considered gold price volatility as well as the financial market predictor, as it could capture uncertainty and a flight to safety, especially when the gold price is high from the behavior that investors are relocating their assets from riskier assets to the safer one like gold. So it could reduce the liquidity in the funding market and make market conditions tighter.
Yeah, that's a good question. We did not consider gold prices or gold volatility. I think if we had done the study now, given events of the past few months, we would have considered it. But at least from our vantage point, gold was a pretty sleepy market segment up until recently. I understand gold is very, very important for the Thai economy and the Thai baht. So if you guys were to do something like this, I'm sure you would include it. But again, I think by now we would include it again, and maybe not only gold, but gold, other precious metals, and so on. Perhaps even broader commodity prices, volatilities.
Thank you so much.
Yeah, thanks, Peter, for the presentation. I've got two questions. So the first one, in terms of the back testing, like do you have like results that show like how well the model can predict the key market stress episodes like the COVID-19 pandemics or the GFC crisis? And my second question would be like in terms of the factors, you mainly consider mainly the short-term market factors, like the flow concepts. Like, do you by any chance consider a more longer term fundamental factors like that better reflects the accumulation of risk, like for example the credit growth or maybe changes in the government debt to GDP, for example?
Mm-hmm. Yeah, good questions. Good question. Let me start with the second one first. We wanted to be able to do this at high frequency. So we need high frequency data, which restricts a number of variables, such as government debt, for example, would be difficult to do at that frequency. Now, one could use, for example, sovereign CDS as an implicit measure of possibly capturing worries about government debt sustainability and that kind of things. I did run some experiments with that for the treasury market, because the treasury market that is the one where we do worst. It didn't affect anything, so we decided not to include it. In terms of longer term variables like credit growth, again, it's difficult with the kind of high frequency approach that we wanted to have. But we have the GFC, the global financial cycle, which captures something similar, at least in terms of market sentiment and drivers of market dynamics, which is slow moving, but still available at a high frequency. So that's the closest we would have. And yeah, I think something we really should be thinking about, because it's becoming more and more important, is the fiscal side, and somehow also for the U.S. Treasury market people are talking more and more about it. So it's in the past one could get away with saying that, oh, the U.S. Treasury market is so safe, no one cares about fiscal situation, but yeah, I'm not so sure anymore. On your first question, which was, oh yeah, specific stress events. So we are not really trying to. We haven't looked at that. We're not really trying to predict specific stress events because the big ones, like the COVID panic, were essentially unpredictable. Or the one I was talking about at the end, the Swiss franc depeg, which is a much smaller shock, but still, I don't think anyone could have foreseen that coming. And so we're really interested in conditions in the market where it is vulnerable to a shock. And if that shock hits, okay, if the COVID shock hits, I think it doesn't really matter what the market conditions are ahead of that. But if a smaller shock hits, like the Swiss franc depegging, then perhaps the kind of conditions that we live in just before may matter, and that's kind of what we want to capture.
Yeah. So sorry, I missed the first half of your talk. I was waiting for a car for too long. It's not really a question, but I just have some kind of technical suggestions.
Yeah.
So in terms of, I had a quick look at your paper, and I found that if I'm not wrong, the data you're working with is a daily data, right?
Mm-hmm.
Yeah. So based on my what I have done before, I did construct a labor market condition index. I use a model, is FAVAR by Ben Beneke.
Mm-hmm.
And I found, but the data I use is a monthly data, is a bit lower the frequency. But in my point of view, I think it might be a good benchmark, like a competing model, because like what you use the AR and also the multivariate one. I think some FAVAR is a bit quasi machine learning,
Mm-hmm.
and also I understand that FAVAR might be work better in terms of the lower frequency. But if you add, for example, gauge component,
Mm-hmm.
so that to deal with the quantum, to deal with the higher volatility, I think that might be an interesting thing to do. Yeah, I think that it really stimulating. I think I'm interested in that as well. And also in terms of the comparison, like the tests, maybe you might consider looking at MCS model confidence set to look at the forecast. And also I saw that you try to do to compare the forecast distribution, which is very good idea. You use the PIT, but I use the PIT for the other sense. But one thing that I did use, and I think I found that very interesting, I used the it looked the simple one, but it's the rich of statistical properties called KS test, conglomerate Smirnov test.
Okay.
Yeah, that will test and that will look at the difference between the distribution. Yeah, but I think your talk is really stimulating, and yeah, I learned a lot. Thank you so much.
Thank you very much. Thank you. I think the FAVAR paper suggestion is very good. We've had other comments saying, "Oh, you're only comparing with a linear model. It's kind of you're giving your approach a little bit too much advantage." So we're thinking of other perhaps non-linear benchmarks we could test it against, but it's not clear what. Maybe some kind of shifting regime model, regime switching model, or something like that. But we'll look into the FAVAR model, and the other two comments are well taken. Those are good suggestions. The Kolmogorov-Smirnov test is something we should consider. So good. Thank you very much.
Hi.
Oh, hi.
Hi. Thank you for the presentation. I work with the AI asset and wealth management platform, and I'd be interested to explore further. I think after the session about the models that you use, because we have about 6,000 data points that we use, and then so far for 6 years we've been averaging about 22 to 24% for the investors. So I'd be interested in wanting to explore about what your additional models or variables that you're using in order to predict the market sentiment other, points that especially pointing to the distressed market. And also, are you working on a model in the GCC, countries? Because right now they are really in distress, and I understand that, the UAE just sees the Iranian, assets. So that's something I'd be interested in further talk.
Yeah, sure. Yes, absolutely. I'd be very happy to talk on these and other subjects. So happy to talk afterwards. We are not looking at other countries or other markets, but for sure one can extend this to other market segments. So it will be interesting to do. Thank you.
Yeah, so I'll leave you and my email in the chat, and then perhaps we can. Yeah. Okay. Thank you.
Perfect. Thanks.
Hi, probably I missed this. Just a simple questions because you compare three models, like the random forest and then the traditional one like AR and the full model. But like, is the information fed in each model are also different, right? So they don't have equal information. So it's not the flexibility of the model, but your model also have a lot of information fed into them, right?
Yeah, well, the full model would have exactly the same information fed into it as the machine learning model. But the full model did so much worse than the simple AR model in terms of the out of sample predictability that we discarded it. We have run the test, the comparison with the full model, but it's like ridiculously bad.
Okay, so I think one last question from the online audience.
Yes, this is Patra from the Risk Management Department.
Hi.
Okay, so I just have one very quick question on, could you please elaborate more on your choice of adopting the skewed T distribution? Because I'm just curious, why not like any empirical distribution like kernel density estimation? Kernel density estimation, because if you have like skewed T distribution, have you even encounter like some parameterization yield in some non-interpretable results, like maybe the mean or the variance is not well defined or something like that? Like, I mean, if degree of freedom is below than 2 or something like that. Thank you.
So no, we did not consider any other types of distributions. We thought that the skewed T distribution would be sufficiently flexible for our purposes. Plus, we have this Adrian et al. Paper that also uses it and was quite successful with it. We never encountered any difficulty in terms of identifying moments or anything. I believe there's just 4 parameters that need to be identified, and we have lots of data in the sense that we have lots of quantiles that we feed into the fitting, and yeah, I didn't see any problems with that. But if you have any suggestions on anything that you think might be better, or any specific concerns that you think would be related to this approach, then I'm happy to, if you send me an email or talk to me afterwards or whatever. So thank you.
That would be great. Thank you very much.
Thanks.
Okay, thank you so much. Thank you everyone for joining both on-site and online. So please join me giving a hand to Peter for an excellent presentation today.
Thank you.
So we have a little bit of time before lunch. So if anyone wants to come up and chat, feel